There is a $1 trillion bet hiding inside the American financial system. You have never voted for it. You will never see it. But if it goes wrong, it could freeze your mortgage, your bank, and the value of every dollar in your pocket. A small group of hedge funds built it. The Federal Reserve watches it every single month. The Bank of England has publicly warned about it. And in March of 2020, it nearly broke the market for U.S. government debt in a matter of days, until the Fed stepped in and quietly spent hundreds of billions to catch it. It is called the basis trade. And by the end of this video, you will understand how a handful of funds turn the safest asset in America into a trillion-dollar time bomb, and why the people whose job is to protect the system are quietly terrified of the day it finally goes off. Let's start with something you already believe. U.S. Treasuries are supposed to be the safest investment on the planet. When governments panic, when banks fail, when markets crash, money runs into Treasuries. They are the foundation everything else is built on. So how do you turn the safest asset in America into a bet so dangerous that the Federal Reserve has to keep a list of who is holding it? The answer is leverage, an enormous, almost unbelievable amount of leverage. Here is the trade itself, stripped down to its core. There are two ways to own a U.S. Treasury bond. You can buy the actual bond today, or you can buy a futures contract, which is a promise to receive that same bond at a set price a few months from now. In theory, these two prices should be nearly identical. They are claims on the exact same thing, but in reality, they drift apart by tiny amounts. A few cents here, a fraction of a percent there. A hedge fund looks at that tiny gap and sees an opportunity. They buy the cheaper one, the actual bond, and they sell the more expensive one, the futures contract. Then they simply wait. Because when the futures contract expires, the two prices are guaranteed to converge. The gap closes, and the hedge fund pockets the difference. Now you might be thinking, that sounds like almost no money. And you would be right. The gap is microscopic. On $1 million of bonds, the profit might be a few $100s. That is a return so small, it is barely worth getting out of bed for. So how do you turn a few $100s into a fortune? You do the trade not with $1 million, but with 100 million. And you do not use your own money to do it. This is where the trade becomes dangerous. The hedge fund buys the Treasury bond, then immediately takes that bond and uses it as collateral to borrow cash in something called the repo market. The repo market is the short-term lending machine at the heart of Wall Street, where banks and funds borrow billions overnight against safe assets. The fund borrows almost the entire value of the bond back as cash. Then it uses that cash to buy more bonds, which it uses as collateral to borrow more cash, which buys more bonds. By the time they are done, a hedge fund can control a position 50 to 100 times larger than the actual money they put in. Put in $1, control 100. That tiny invisible profit on each bond is now multiplied 100 times over. The microscopic gap becomes a serious return. And for years, this trade printed money so reliably that it became one of the most popular strategies in the entire hedge fund world. So how big has it gotten? As of 2025, the Federal Reserve estimates the basis trade is worth around $830 billion, roughly double its previous peak. And measured by the full size of the positions these funds control, it crosses $1 trillion. This is no longer a clever niche strategy. It has become a load-bearing pillar of the largest bond market on Earth. And that is exactly the problem. Think about what is actually holding this trade together. It depends on two things staying calm. First, the fund needs to keep borrowing cash cheaply in the repo market, rolling the loan over again and again. Second, it needs the price gap between bonds and futures to behave normally and slowly close. Now imagine a moment of real panic. A crisis hits. Everyone wants cash at the same time. Suddenly, the cost of borrowing in the repo market spikes. At the same time, the exchange that handles the futures contracts gets nervous and demands more money up front as a safety cushion. That is called a margin call. The hedge fund now needs cash, fast, from two directions at once. What does a fund do when it desperately needs cash? It sells what it owns. And what does it own? Hundreds of billions of dollars in U.S. Treasury bonds. So it starts selling. But here is the trap. It is not the only fund in this trade. Dozens of them are in the exact same position, getting the exact same margin calls, on the exact same day. They all rush for the exit at once. Hundreds of billions in treasuries get dumped onto the market in a panic. The price of the so-called safest asset in America starts falling fast, which triggers more margin calls, which forces more selling. A spiral begins, feeding on itself. And this is not a hypothetical. This is a description of what actually happened in March 2020. When the pandemic hit, basis traders were forced to unwind their positions, selling roughly $100 billion in treasuries in a matter of days. The market for U.S. government debt, the deepest, most liquid market in human history, started to seize up. Buyers vanished. Prices swung wildly. The Federal Reserve had to step in with one of the largest emergency interventions ever seen, buying up treasuries at a staggering pace to stop the collapse. They did not do it to bail out hedge funds. They did it because if the treasury market breaks, everything breaks. Mortgages, car loans, government borrowing, the value of the dollar itself, all of it is priced off of treasuries. So the Fed put out the fire, but they did not remove what caused it. Because here is the uncomfortable truth. After 2020, the basis trade did not shrink. It came back bigger than ever. Today it sits at roughly double the size it was when it nearly broke the system the first time. Regulators know this. The Bank of England has flagged it as a systemic risk. The Federal Reserve publishes papers tracking it month by month. Economists have proposed building an entirely new emergency facility just so the Fed has a tool ready for the next time these trades unwind. They are, in effect, pre-positioning the fire trucks because they are no longer asking if this trade causes a problem. They are asking when. And this leaves us with a deeply strange situation. A trade most people have never heard of, run by a handful of hedge funds, financed with borrowed money stacked 100 layers deep, has become so large that the Central Bank of the United States has to stand permanently ready to rescue it. The profits are private. The risk is yours. Because if it unwinds badly, the cost lands on the entire financial system, which means it lands on you. The basis trade works beautifully right up until the day it doesn't. And the only thing standing between that day and a full-blown crisis is the willingness of the Federal Reserve to step in one more time and catch a trillion-dollar bet before it hits the ground. The question regulators are quietly asking themselves is simple. What happens if one day it falls faster than they can catch it?